and welcome. You're watching The Money Show. I'm with you, Kavita Thaplial, and yes, a special show where we'll be talking about all the market triggers and also triggers for your investment strategies. How should you be going ahead with all your investments and the strategies that you have lined up for all your financial goals? This is the show where we talk about different investment instruments and also answer your portfolio-specific queries. So just in case you have just tuned in, all you have to do is note down the WhatsApp number that's flashing on the screen and our email ID where you can send across your questions, and we have our experts who are going to answer your questions live and do your live financial planning session. But before we switch on to that, let's just talk about the current triggers working on the market. Markets are navigating a dense mix of signals. Global trade momentum is being reshaped even as India signs landmark deals with the US and the EU to sustain growth. Domestic policy remains steady and earnings continue to test investor patience. The RBI, for its part, has struck a note of continuity. Inflation remains below the tolerance band. The MPC has unanimously voted to keep the repo rate unchanged while maintaining a neutral stance. Now, even as it acknowledges that external headwinds have intensified since the last policy, near-term inflation and growth outlook remains positive. Though CPI forecasts for the first half of FY27 have been revised slightly upwards, partly due to price pressures from precious metals. Now, this policy steadiness comes alongside a union budget that stays in course on fiscal consolidation, leans heavily on capex-led growth and offers targeted incentives for new age sectors, even as concerns around execution, policy sentiment and subdued earnings persist. Now, against this backdrop, the key question for investors is whether markets are in a phase of healthy consolidation or quietly repricing risk. Let's talk to Aditya Khemka on all of these factors. Aditya, hi, and welcome to the show. Thank you so much for taking your time out today. Let's focus on the macro view. Now, markets seem to be digesting the gradual phasing out of trade deal momentum. Now, I just want to understand too many events happening in the market lately. What's the current market behavior broadly? Do you think it's on expected lines? Are we underestimating the second order effects on flows, currencies and risk appetite?
Hi, good afternoon and thanks for having me. So on the markets, I would say, post-budget and post the recent policy announcement, etc., I feel markets have behaved along expected lines. Look, there are two forces acting on the markets. The valuation and earnings is one aspect of the market, and the second aspect of the market is the liquidity chasing the assets. So if you look at the earnings and the multiples at which the markets are trading, we believe, historically, if you see Nifty 50 average earning multiple, P multiple used to be 18, 19 times, and average earning growth used to be 13, 14%. So if you take the PEG ratio of Nifty 50 over, let's say, last 20, 30 years, it used to be in the range of, 1.4 to 1.7 times. Today, if you look at the same numbers, Nifty 50 at about 20, 21 times P multiple and about 7, 8% bottom line growth if you exclude commodity companies, then you're looking at a PEG multiple of almost 2.5 to 3 times. So I think markets are clearly not cheap. Are we sort of fairly valued? Maybe even not. Maybe we are slightly expensive. But that's on the headline indices. I think the moment we go beyond the top 250 stocks, which is the large caps and the mid caps, we dive into small caps. There are many opportunities today to deploy capital where, stock prices are reasonable, valuations are reasonable, and, earnings are growing. So you get a good bang for your buck, so to say, in that pocket. But I think large and mid caps, if you sort of define market by the large and mid caps, there I feel there is limited potential to make extraordinary returns. One can expect high single digit to low double digit or low teens kind of CAGR from here. But I don't see, significant upsides from that perspective.
Sure. We'll be digging more deeper into this, but then before I go any ahead, I just want to understand, is the policy announcement on expected lines for you?
Yeah, I think if you're talking about the monetary policy where RBI did not cut the rates, I think that's along expected lines. I think, inflation is under control. Growth isn't really, subdued or exorbitant. So you are basically at a reasonable path on growth, especially if you look at the real growth of the economy. And more importantly, if you look at the geopolitical situation, right, where you don't know how the Japanese yen and the US dollar is going to behave, given, what is happening geopolitically in those two countries, I think it's a good measure from RBI to sort of take a pause and reevaluate things as more data emerges. I think that's a clever decision.
Right. Okay, coming back to the macro aspect of it, and obviously talking about the global trade uncertainties, near-term tug-of-war between global trade uncertainty and domestic policy support playing out for Indian equities, right? I want to understand what factors dominates over next 3 to 6 months, according to you.
Yeah, look, I think domestic growth for the past 4, 5 years, I don't think has been a challenge. In fact, I could even go to the point of saying a decade. Domestic factors have been in favor and they have been playing out as, one would have expected. I think where we have had significant disappointment, or rather, I would also put it as where we have significant scope for improvement, is exports. So if you talk about domestic policy and how the domestic market has behaved over the past decade or so, I think is broadly in line and it's not at all disappointing. It's, more or less in line with our expectations and what one would have expected from an emerging economy like India. I think where India has been slightly disappointing, in my view at least, has been the exports situation. So if you look at the history of all the major large economies in the world, be it the United States, be it China, be it Germany, what you figure is that, these companies grew out of proportion or grew very fast because they started doing very good exports. And that is really the key growth driver. If you want to become from an emerging economy, you want to become a developed economy, your export growth has to support your domestic growth. And I think that's where the global macro is far more important and relevant for India today. The local macro has to support, and that support we have. So that's a very good tick to have in the box. But the real kicker in the growth should come from exports. Now, in exports, as you know, we have had the EU FTA, and with the US, there is talks of a trade deal. I haven't seen the fine print of the trade deal that the politicians are talking about. But if, let's say, the fine print is supportive of an export growth situation without cannibalizing much of the domestic growth, I think investors are missing one point here, and I would like to point that out. When you open your market to foreign companies, you are compromising on domestic growth. You're giving away some of your domestic growth to foreign companies in terms of earnings. Yes, you get export growth in exchange, but the net number has to be in your favor. Now, to judge whether that is, or to evaluate whether that is actually the case, we'll have to see the finer print of how the EU FTA and the US FTA, what are the finer prints. And then that we'll be able to maybe arrive at a conclusion. I think that's what the markets are really waiting for, the finer print.
Right. But then still, can we expect a layered impact? What I mean is, when you layer the union's budget's capex push, okay, and fiscal consolidation with evolving trade dynamics, what does the combined impact look like for growth visibility and market multiples in the near term, especially? Yes, we are waiting for the fine print to come and also the implementation of the deal, which will be somewhere between in mid-March, only when, we get the legal authority over it to execute. But having said that, what kind of visibility in terms of market multiples are we looking?
So I think domestic policy being supportive and some part of export continuity, we are looking at GDP growth maybe in the range of 8 to 9% in terms of nominal, and maybe real GDP growth in the range of 6 to 7. And I think that's a number which is fairly satisfactory. Again, not out of our expectation ballpark. But if we have to, sorry, but if we have to accelerate that number, we have to look at exports. So for now, I think from that sense, the market multiples do seem elevated, again, because 7% corporate earning growth. And in the next year, this year, we are obviously at 7-8%. So next year, if it's 10-11% corporate earning growth with a P multiple of about 20-21 times, you're still at 2 times versus historical average of 1.4, 1.7.
Let's talk about the broad takeaways from the budget. And here I want to talk about the incentives for new age sectors like data centers, AI, electronic manufacturing are clear positives, Aditya. Which of these themes do you believe can deliver tangible earnings impact in the near to medium term rather than, remaining a narrative driven thing?
No, that's a very interesting question. Look, the entire cloud-based computing, etc., and the AI cloud that the government sort of gave impetus to in the budget, I would say that still may not translate to near-term earning growth. These are obviously budgeted numbers, these are plans, and these are obviously multi-year projects. I think in the near term, if you're looking for earning growth, you just still have to rely on consumption, lending, credit growth, and you still have to rely on healthcare, as your key growth drivers in the near term. I think from the budget, I couldn't find any measures which would tell me that in the next 6 to 12 months, or you would have any significant improvement in earnings. But all the measures that were taken in the budget seemed fairly long term in nature. Now, as fund managers, that makes us very, very happy because at the end of the day, you do want your economy to do well. You do want an economy which is fundamentally sound, and your valuation multiples are a function of your long-term fundamental strength. And eventually, when those long-term triggers play out and when those earnings flow through, you're looking at India becoming a very, very big superpower in the world, economically speaking. So I don't think in the budget I saw anything which was a very near-term positive. That near-term positive, everything we saw pre-budget, where we saw the GST cut, we saw the rationalization of income tax rate up to 12 lakh rupees of income. I think those were the more near-term measures. But the budget that, as it was presented, didn't show me anything which was very near-term in nature.
Absolutely. But then let's also focus slightly on the flip side. And since we're talking about all the, impact and effects being shown in the long term, on the flip side, subsidies, pensions and interest costs continue to dominate the expenditure. When we talk about structural limit, does this structurally limits India's ability to sustain a high quality capex cycle?
It does. So end of the day, you have to see what the government earns and what it spends. India's marginal tax rate. I think this is a well-known fact, established fact now. In India, corporates pay less tax than individuals do. So in our total direct tax collection, the share of income from individuals has overshadowed the share of tax collections from corporate. That one is not a good signal because that basically signals lower disposable income for individuals and hence lower consumption growth. Add to that, if you're looking at, let's say, the indirect taxes which got cut, you're looking at GST rates being rationalized on the lower ticket items, which again may support the lower income and bottom of the pyramid sort of population, but not really at the higher end. It doesn't make any difference. So I would say, if I look at the total fiscal situation of India, yes, given the income tax, the interest payments, and given that we have still allowed capital expenditure budget to grow, it does require some borrowing, and hence your credit growth in the system might remain a little suppressed because banks will end up, lending to the government instead of the retail people or instead of the corporates. And that will put some pressure on credit growth and maybe even NIMs eventually. But that does protect the asset quality of these companies. So I would say, India is in a tricky situation where our obligations are weighing over our wish and wants on the capex side. Having said that, we can bridge that gap through borrowings, but we can do that only for so long because, as you can see, the rupee is depreciating, and that is basically a signal towards the Indian economy becoming more, or the Indian government becoming more leveraged because of its growth aspirations. So that is not a sustainable trend in my view. We have to, and which is where again I come back to my point on exports, that if we are able to encourage exports, if we are able to earn more foreign currency, pay down some of the debt, the government debt, then the interest payments can really come off, and then the economy would be more sound, more fundamentally strong than it is today.
All right. Let's talk about the earnings and sector and market strategies now for the investors. With earnings growth remaining subdued across several pockets, how should investors recalibrate expectations for broader market returns over the next years now?
So look, I think we are in a low return environment. That's pretty much clear to me. From 2020 to 2025, we've had a dream run in equities. I don't think investors should expect or extrapolate that dream run into the future. You have to reset your expectations. You have to, at this point, I think we are looking more from a protection plus growth perspective rather than just growth. So, when we advise our investors, when you look at our products, our portfolios, we have a significantly higher weight in healthcare companies, healthcare being a sector which is far more defensive, secular in nature. Yes, the return expectations from healthcare cannot be 20-25%, something that you can expect from cyclical sectors if you get the cycle right. In healthcare, you cannot really have those kind of return aspirations. But if you have, a low teen or a mid-teen return aspiration, that is something that sectors like healthcare can meet for you. So I think we are in a low return environment, and we are creating portfolios for our investors today, which offer more protection plus growth rather than just pro-growth portfolios. And I think, investors have to tune down, because at this point, if you still carry high return expectations and you end up investing in very risky asset classes, you risk a lot of your capital in that endeavor. and hence, the protection part of the portfolios vanished from that. So I would advise investors to tune down their expectations of returns and be invested in relatively safer portfolios with more defensive names in the portfolio rather than cyclical ones.
Right, right. Let's also, talk about sector specifics. Any sectors where valuations have run ahead of fundamentals, especially in the context of muted earnings delivery?
Yeah, I would say many such pockets. Again, even within a given sector, there are names which are horribly expensive and names which are ununderstandably cheap. So I wouldn't say sectors, but I can probably tell you that I think private banks, large private banks are probably overvalued. Large NBFCs are probably overvalued. Smaller NBFCs, mid-sized NBFCs seem undervalued. Regional banks, small corporate banks seem to be undervalued. MFIs seem to be extremely undervalued, extremely cheap at this point. Healthcare companies seems to be fairly too undervalued, the smaller ones especially. The larger healthcare companies seem to be somewhat fairly too overvalued. And again, I think autos being a cyclical sort of sector, I think I find some of the OEMs slightly overvalued. And IT companies, although they optically look cheap, but because there is a huge amount of speculation right now on whether they'll be able to sustain earning growth, given the advent of AI and how they are adapting to AI, that's another pocket which we're very cautious on. So, it's a stock pickers market, if you ask me. I don't think one should make a blanket statement on a sector, but there are stocks which are horribly expensive and do not offer a good risk reward at this point. And there are stocks, mostly in the small cap side, where there is pretty good risk reward situation at the current time. But obviously, that will play out with patience. So, again, coming back to my original point, your return aspiration has to be low and your investment horizon has to be slightly longer.
Exactly. So it's a stock pickers market, investors market, and definitely lower your expectations. With that, thank you so much for being a part of this show and helping our viewers navigate their financial strategy for all their financial goals today. Thank you so much.